Let us use this scenario here to explain the financial function. I mean, the illustration I have on the screen, right? The financial function is mostly used in a financial organization, financial setting, and it's useful famously when loans were given out to some borrowers, and you need to calculate without error the amount that the borrower is expected to pay per period, right? Per period, which would have been stated and all of that, right? You have the interest, the loan is given at a particular interest rate and all of that, right? Now, let's say, for example, let's look at this illustration I have on the screen, right? We consider a loan with monthly payment and annual interest rate. So we want to calculate the monthly payment, which is going to be here, right? But this is supposed to be done with an annual interest. The interest is 6% annual interest, but then it's expected to be paid every month. So we are going to break the annual interest of 6% to 12 months. We say 6 divided by 12, and we would have 0.5%, right? 0.5%. Our NPER stands for number of period, right? And in this case, the number of period will be 12, right? So we are expected to keep paying the loan, keep servicing the loan for 12 months, right? And I have the PV function. The PV is an acronym for present value, and that is the word we use for how much did you get from the borrower or from the bank, as the case may be, right? Let's, for example, I borrowed 50 million naira from the bank, so my present value is 50 million naira, right? Fine. And there's another last term that is called future value, FV, future value. Usually the future value can be ignored, right? And we can take it to zero. So it's telling us is only explaining that after servicing the loan for 12 months, how much are you expected to have, right? How much are you expected to have to pay again after the 12 months? And usually, if there's a loan after 12 months, you should have complete the payment, and you should have nothing to pay again. So future value can be taken for zero, especially when it is used in the case of loan, right? So now I want to calculate what's my payment. How much am I expected to pay every month? Every month. So it's so simple. I'm going to use the PMT function, and I'm going to call it out to say equals to PMT. Call out the syntax. I have the first argument to be rate, right? My rate is 0.5%. Number of period, how long am I expected to pay it? 12. Present value, right? Present value is what I'm taking right now, the amount I am taking right now, which is 50 million naira, right? And I have the FV, right, which is zero or can also be ignored. The final argument, which is type, can also be ignored as well, right? Recall that in Excel function, any argument that is enclosed in this kind of brace bracket, can always be ignored, right? So if I say enter, then I will have, it means that monthly I'm expected to pay 4,303,321 naira 49 kobo to my borrower. But then note that I have a negative sign here. The negative sign is explaining that amount, the 4.3 million naira, is to be paid out. I'm not going to be getting it. I'm paying it out, right? That's why we have a negative value there. And that's fantastic. I hope that is clear, right? So on the other hand, let's say, for example, I know my payment, my monthly payment, right? And then I don't know the rate. I know my monthly payment, I don't know the rate. I know every other value. So I want to calculate the rate. I'm still going to use the rate function, and that will be equals to rate. And the same way I've calculated it for the payment, I'll go ahead to input my argument. Number of period will be 12. Payment will be minus 4,303,321.49. Right, that's my payment. And of course, my present value will be 1, 2, 3, 4, 5, 6, 50 million, and every other argument can be ignored, right? And you can see that I have 0.5% as my rate, which tally with what I have here. And you can do the same thing for all other ones if you need to calculate them, right? That's fantastic. let's move ahead a bit and let's come here, right? Let's say, for example, now you have taken a particular loan from a bank. You have taken a particular loan from a bank. You know your payment, right? But then this payment, one of the things you know about the payment that you have calculated, which is 4.3 million naira, as the case may be. One of the things you know about is that two things are embedded in that figure, right? The PMT, which is your payment, is the summation of both the principal payment, which is PPMT, the principal payment, right, and the interest that the bank has placed on it. So we call it interest on payment, which is IPMT, right? So the same way what I've done, let me repeat that again on this new screen. My PMT is equals to, I'm going to have the rate to be 0.5%. NPER is 12, and my future value, my present value is 1, 2, 3, 4, 5, 6, 7, right? I can ignore all of that and say that, right? You can see that I have the amount repeated here. Now, out of this 4.3 million naira, how much is my actual payment for the actual payment for the 50 million I've borrowed, which is my PPMT. I'm going to use the PPMT function to to get that, and that would be, what's my rate? My rate is, of course, it's still 0.5%, right? And I have this very uncommon, this very new argument that is called just period. This is different from NPER, which is number of period. I have just PER, meaning period. So I want to know what is the amount that I'm supposed to pay for this month. Let's say, for example, you're expected to pay between January and then December, right? So January being 1, February being 2, March 3, and December 12 in that arrangement of number of months, right? And then you want to know the amount I'm expected to pay as of this month that I am, out of this present moment that I am, which is January, right? So it means that my PER, which is period, the present period, would be 1. And I will just come here to select this one to see that that is my PER. Then I cannot say, of course, I'm expected to pay for 12 months, which is my NPER, 12 months. Then I have also my PV, present value, remains 1, 2, 3, 4, 5, 6, which is 50 million naira. Then I can close the brackets, right? Now you can see that out of this amount, right, out of the 4,303,321 naira and 49 kobo, which is my monthly repayment, 4,053,321 naira and 49 kobo is the actual, actual repayment for the loan, right? And I've gotten that A. Now, the other amount that is subtracted from this is the interest that the bank has placed on it. And I can also calculate that using the IPMT function, right? And I'm going to say IPMT, call it out. My rate remains 0.5%. Note that the percent must be added to it, right? Of course, my PER is still now. I want to calculate the interest for now. And then the NPER is 12. I'm expected to pay for 12 months. And I have my PV, which is the present value, and I close the bracket. If I say enter, so it means that on this, right, the interest that the bank has placed on my loan per month, I mean for that particular month, for that January, is 250,000 naira, which is fair enough, right? So my justification here, I have this justification here to now balance it. Let's see, equals to if I had this amount, the principal payment, if I add it together with the interest, I should have my actual payment. And you can see that it is justified. Look at the value here and the value here. It is actually justified, right? So this is the amount I'm expected. This is the amount I'm expected to pay, right? In January. So how much am I expected to pay in February, right? Let's do this. Let's know, of course, our total will remain the same, right? Our total would remain the same. And then let's see for every other month. For every other month, these are the amount we are expected to pay for every other month. For February, you should pay 4,073,000 and all, and that. For March, you should pay 4,093,000 and all, and like that. So until you get to December, which is your last month, you will be expected to pay 4,281,000 naira, 911 and 93 kobo. And on each of them, the interest on them would be, it also varies. In the first month, the interest the bank has placed on you is 350,000 naira, but in the second month the interest is 229, right? So it means it actually varies, right? And we can see the justification also, being placed together. So in the end, the total interest on the 50 million naira that you have borrowed is now given here. We can see that the interest on your 50 million naira is just 1,629,857 naira and 82 kobo, which is it sounds to be a good interest. Look at your principal. Your principal payment is still 50 million naira, which is the actual amount you borrowed from the bank, right? And you have the interest, and you have this total, placed on it. This financial function is very important to know, right? Especially if you are the head of accountant of an organization who would, take loan to complete a particular project, or you are the CEO, you own a business, and right, you have been given a project to handle, and you need fund to execute the project. So you want to know, you are taking a loan from the bank or from a borrower at a particular interest rate, right? You want to know what you are expected to pay without being cheated or being feel cheated by the borrower. You can use this function to calculate your expected payment per period, and then have them, detailed, kept in the record, right? This is fantastic. I hope you've had a good time, talking about the financial function today. Please look at the the red button down the screen. Kindly subscribe to our channel, and I will bring you to another important skill on this Excel in the next class. Until then, have a very wonderful day.